In today's video, we're going to talk about the Augusta Rule, aka the Master's Rule, aka Section 280A of the tax code. In a nutshell, what this section of the code enables business owners to do is rent their house out to their business for a reasonable and ordinary business purpose and deduct the rent that you're paying to yourself as the owner of the house. This is a really popular strategy. I've talked to a lot of people over the last couple of years who want to utilize this strategy. Some people I think have done so too aggressively. The reason we're covering it in today's video is because we have a recent IRS case that's provided some guidance surrounding the rules and regulations when you use this strategy and gives us some color surrounding what you need to do from a documentation standpoint and where this whole thing can go wrong. So the reason that this rule is called the Master's Rule or the Augusta Rule in the first place is that it comes directly from the Professional Golf Association, the PGA Tour's Masters tournament that takes place every April. Now, this tournament is one of the four major tournaments that the PGA hosts, and people come in from all over the world to come see it. And people who owned houses and live right around where the golf tournament takes place have rented their homes out to visitors coming to see the golf tournament for years and years and years. Well, for a long time, they've wanted to deduct the income that they've gotten from renting their homes out for this golf tournament in whatever form that they could. And apparently, they kept pestering their representatives at the local, state level, and then it went all the way up to the IRS. And at some point, the IRS agreed with them and incorporated this. I wouldn't call it a loophole, but rule into the Internal Revenue Code, whereby if you have a business, the business can rent your personal house out for legitimate purposes for up to 14 days a year. Your business pays you, the individual. You, the individual, get the cash, put it in the bank, and it can be a deductible business expense if you do it right. So that's where the whole thing comes from. The case in question here is called Sinopoli versus Commissioner. It was argued in August of 2023. And in a nutshell, the taxpayers had an S corporation that was renting their personal residence. And an IRS examiner pulled the corporate tax return for audit. They wanted to dive into the rental expenses claimed on that tax return by the corporation because they totaled, I think it was $290,000 over a 3-year period. So they dug into it further and further and further and then realized that the items being rented was the taxpayer's personal residence. Now, ultimately what happened here was that the IRS ruled and upheld this section in the code, meaning that the strategy is legitimate and works, but it negated most of the deduction that the taxpayers took because they simply didn't do it right. So what we've learned for this is there are three main ways where you can go wrong using the Augusta rule. One way is that you have to do your research and document that research surrounding what you're charging your business in terms of rent. It has to be reasonable and fair market value. And in this case, and maybe they had other rental expenses too, but this is over a 3-year period that was examined. The total rental expenses deducted were like $290,000, as I said. Now, remember, you can only do this for up to 14 days a year. And if that was their only rental expense, that implies a daily rental cost of more than $5,000 a day. Well, what the IRS examiners argued successfully was that for a comparable rental unit in that area, the cost would have only been $500 per day. So that's ultimately what they got to deduct. They deducted way more than they should have because what they actually charged the business was way beyond fair market value of anything in the area. So number one, you have to do your homework, research what fair market value is for a similar rental property, and don't charge your business anything beyond that. That's number one. Number two, remember that any business deduction needs to be ordinary and necessary. And what the taxpayer got in trouble for here was they didn't document what the meetings were for. They simply rented their house to their business and then called it good. What you need to do if you're going to take advantage of this strategy is document minutes, have an agenda, have a list of attendees, have some documentation surrounding what legitimate business activities take place in your house that your business needs the house for. Because without that, there's no way to argue successfully that the business needed to rent out the house. And that's really the third way that you can go wrong as well. And this is true of any business deduction. They always have to be ordinary and necessary. So even if you rent your house out to your business for 14 days a year and it's for fair market value and you document everything that goes on, you could still lose an argument that that expense was not ordinary and necessary. So for example, I spoke to somebody just this morning, as a matter of fact, who had hired a tax strategist kind of person to help them reduce their ultimate tax liability, both in the business and in their personal finances. And this tax strategist suggested that they could save them over $100,000 on their taxes by taking advantage of the Augusta Rule. Well, the taxpayer, this person I spoke with this morning, was smart. This didn't pass the smell test. He elected not to go this route, which is wise because he has a single member LLC that files as an S corporation. He's the only employee. What could he possibly do in his own house to justify that level of deduction? That's not ordinary and necessary as far as a business deduction goes. So anything that you do in your business, including a rental deduction for your own house, has to be ordinary and necessary in the course of doing business. And what the IRS argued successfully here was that not only were they charging their business far too much for the rental, but because they didn't have the documentation commenting on what actually happened in the meetings, the expense wasn't ordinary and necessary in the first place and was therefore thrown out. So the result was that the taxpayer lost the case. I don't know whether they had to pay any penalties for understatement of tax or not, but I assume that they did. So when you execute this strategy on your own, make sure that you're doing those three things. Document the fair market value for a similar location in your area. Don't charge your business any more than that. Document exactly what happens at these meetings. And third, make sure that it's an ordinary and necessary thing for the business in the first place. I hope you liked today's video. If you did, make sure to hit the like button at the bottom of the screen and subscribe to the channel to make sure that you're notified anytime we come out with something new. On top of that, if you're not sure whether you're on track financially, you might want to check out our free wealth gauge assessment. There's a link for it in the comments. Basically, you click the link, you take 3 minutes to fill out some basic financial information about yourself. We take that information and run it through our financial planning software. Then we send you via email a short private video of our findings and 30,000-foot observation.